All right. So, like I was saying, this risk warning. You can just maybe take a picture and see what it speaks about, so you know the risk involved in trading. Okay. All right. So I can continue now? All right. So like I was saying, this is the introductory level, and it's stuff which you need to know in the long term. Regardless, a lot of guys, they just jump into it and they don't know some of these principles, and it hurts them in the long term. Even if they learn whatever strategy or whatever it may be, but they miss out because of the principles which they've got wrong. So this is what I'm going to teach you, so you have an understanding of all of this. Okay, so let's just continue. So what is CFD trading exactly? Let's just see. Okay, so CFD trading, it stands for contract for difference. All right, contract for difference. So it's an agreement, as you can see there. If you want to take notes or take a picture of that, it's an agreement between an investor, which is you, and the broker, which is the dealer that you'll be dealing with, for the exchange in the value of a product, a commodity, currency, yeah, depending of what the price is when the moment you place the order and when you close the order. Okay, you understand that? Okay, you understand? Hello? Hello? I saw you're gone off, but do you understand that? What the contract for difference is? Hello? Yes. Did you hear what I said? Okay. So a CFD investor, that is you, contract for difference investor. You don't actually own the asset. Like, for example, if you're trading currencies, let's say if you're trading a pound versus US dollar, you don't actually own the pound or the US dollar. You just are speculating of whether the US dollar will go up or the pound will go up or down. And you make money based on the difference in value. Okay, that you understand. It's just like with gold, because you can also trade gold, but you don't actually own the gold. You understand? But you're dealing with the broker. But you place a buy order, you place a sell order, but you don't own the gold. So that's what a CFD trading is. Okay, so anything, you can trade oil, you can trade gold, you can trade shares. Also, as long as that broker offers CFD trading and you meet the requirements, you can trade that asset. Okay. So the disadvantage of trading CFDs is that the moment you place an order, already you are in a loss. Okay. Okay. So like as I was saying, the disadvantage, the moment you place an order, the broker charges his spread. So you are on the negative. But of course you make your money later. Okay, you understand that? And some of the other risks is like the regulation, because some brokers, they don't play according to the rules. Like you can place an order and they hold it for even 30 seconds or to a minute. It may not be much when you're dealing with small amounts of money, but when you're dealing with larger amounts of money, when they delay your order by that 1 minute, it's very costly. It's quite a bit of money. So it's always important to get a good broker, a good broker. And as well, one of the other risks is this part here, adequate margin. A lot of traders ignore this, but we'll discuss this today. I hope you've got your notepad. When we get to that point, you need to remember this adequate margin. because a lot of it missing. Okay, so what and who can trade CFDs? Okay, you can trade stocks, shares, futures, commodities, indices, forex. So a lot of people just think it's forex. No, it's not only forex. You can trade some stocks, which is shares. You can trade some futures. You can trade commodities, like I just explained to you, gold. You can trade oil. You can trade silver. You can trade platinum. There's many things which your broker will offer you to trade. Okay, so as long as you meet the requirements of your broker, you can trade. Okay. So we've got institutional traders. Those are the big banks, the hedge funds, and the pension fund managers. And then we've got individual traders, which is retail traders. Okay. So the most popular things that are traded by retail traders like you and me is forex, commodities, and indices. This is because there's not much requirements for that. Okay. So with all these options, let's see, why is it that many retail traders focus on forex? Okay, so here's some interesting facts. The forex market is the largest globally in any market, more than what's traded on the London Stock Exchange, the New York Stock Exchange. It's the largest, you know, it's the largest amount of money that flows through globally. Okay. So it's an estimated $4 trillion traded every single day on the stock market. I mean, sorry, on the forex market. So even if you come in with your $100 or $200, it's just adding to this massive ocean, massive ocean of money that's transacting. But they've made it possible that you can enter, because why? They also want your money, because they know $100 times 1 million, it adds up. So that's why they allow retail traders to come in. Okay. But an interesting thing is that this market is not really controlled by anyone. You understand? It's not like in a case of if you're dealing in something like, say, oil, and then you've got the OPEC countries, and they decide we're raising the price of oil. You understand? Then the price of oil goes up. But with forex, it doesn't work that way. It's basically a supply and demand. Okay, because there's such a large amount of money that is flowing through the system. So it gives some transparency on that part. You understand that? It's very difficult for one individual to control the price of a country's currency. That's basically what it is. As well, the forex market is traded 24 hours a day, 5 days a week. Okay, it starts as the day starts, which is in Asia, Australia, those areas, and it ends in New York, which is where the day ends. Okay, so the major centers, like it's Japan, Sydney, those areas. Then we've got the London session, which is basically London and Europe. That's when, and then we go to the New York session. That's Monday to Friday. Okay, so like your time, the time zone where you are, you're basically on the London session. Most people in Africa, we at the advantage because most of the activity actually does happen during the London session. Okay, so there's 3 major trading sessions in the market based on time. This is very important, and this is when most of the activity happens. Okay, because you can find some guys, they want to be up at maybe 1 a.m. in the morning trading, or 12 p.m. You don't need to do that because no one is up at that time. Even in Asia, the session hasn't yet begun. You understand? It's just like activity happens when businesses open. So it's the same with the trading forex, and even trading, the same goes for shares, the same goes for indices and everything, because there's people who are controlling these things. Okay, so the first session there, Central African time, Asian session, that's 12 midnight to 7. Then you have the London session, Central African time, that's 8 to 4. And then the New York session, which I say is around about from 2 to 11 Central African time. So for your Kenyan time, you just add 1 hour onto each of those to get the sessions. Okay. So what else can you trade? CFDs, like I've explained to you. Forex is most popular, but you can trade commodities, you can trade precious metals. With most brokers, you can trade indices like the NASDAQ, the Dow Jones. Nothing difficult. You hear all these big names, the S&P 500. Those are all just indices. We'll get into that later, so you have an understanding. But you can trade that. You can trade volatility indices. This is now very popular with most retail traders. It's just basically like an index, like the NASDAQ, where they say they are checking how volatile, how much the market is moving, and you can trade CFDs. Many you can place to say if it's going to go up or if it's going to go down. Okay, that is binary.com or deriv.com. You can check it on the internet and see what they offer. You can also trade it. I've traded it, right? And then shares and stocks, but very few retail traders are able to trade shares and stocks because of like the high demands. Most brokers, they really require quite a lot of equity, although some do offer CFD trading, but you need like 10,000 US to trade that. But some, they do offer where you can trade it with a lower amount. Okay, so how do you trade? Now that you know what it is, what a contract of difference is, you're buying and selling, money is made. This is the basic thing. If you can understand this, this is all you need to know whenever you want to place a trade or anything. So money is made when you buy the asset, when it is at a lower price, okay? And then you sell it back when it is at a higher price. Let me see if I can get a pen here, okay? So you buy it, like for instance, let's just say, if you can see my chart here, I'm just drawing, right? So this is the price of whatever you can say, even bread. Although not many offer the selling of bread, but let's just say, for instance, the price of bread. So this graph will be going up like this, down, up, and that kind of thing, right? So let's say you buy here. You say, I want to buy bread here, and it is $1, right? So with CFD trading, you buy the asset when it is at a low price. So you're buying it here, you're anticipating this is too cheap. $1 is too cheap. Price must go up. So you're expecting it to go up. Remember, this is time at the bottom here. This is time, right? At the bottom here, this is your time. So you buy it at $1. Then when it goes up and it reaches, say, somewhere there, which is $2, then you say to your dealer, you say, right, I'm selling back this asset. So you didn't actually own the bread, but you placed it to say, I'm holding it, I've bought it at $1, and now I'm selling it back to you at $2. So what basically happens is that the dealer has to sell to you here, and then he has to buy back from you here. Okay, if you understand that. So basically that's all it is on CFDs. You want to buy, if you're buying gold, whatever it is, you want to buy it when it's lower and sell it when it's higher. And the same case, okay, let's just say the same, okay, let's use gold, right? So this is gold here, and then this is time here, right? Time is going that way. This is the price of gold, right? So I showed you when you're buying. Now let me show you when you're selling. So let's say our price was like this. So at this point, let's say gold is maybe here it's $1,000, right? 1K. So when you hear, you like, this price is too high. Gold $1,000, this price is too high. So you're saying I'm selling here. So you place a sell, right? Then price goes down. It goes down with time, and it reaches maybe say $500, right? It reaches $500 somewhere here. So when it reaches $500, you say, right, it's dropped enough. I'm now going to buy it back. Okay, you understand that? So you've sold it at 1K and you've bought it back at 500, meaning the difference of that 500 is what you make. Okay, so that is all about, we'll get into that, your take profits, your stop loss. So just remember this, you buy low and you sell high, as I've given the example. You buy when price is low and you expect it to go up, and you sell when price is high and you expect it to go down. Okay, so as we've learned, like remember I explained to you, there are those guys, institutional traders. Those are like the banks, the pension fund holders, hedge fund managers, all that. So those are the big guys, right? Those are the big players. And then there are the individual traders, right? Which we call retail traders. Okay, so we're going to look at what it is that you as a retail trader, what exactly is trading like for you as a retail trader. Okay, so let's just get into that. Okay, so these are the two advantages and disadvantages, we can say, of institutional traders and retail traders. Okay, so as is pretty obvious with institutional traders, big banks, they have what? Very large capital, isn't it? They have large capital, right? Hello? Yeah, I'm saying the institutional traders, they have got very large capital, right? These guys have got large capital. Retail traders, they're limited to how much money they actually have, isn't it? Another difference is that these guys have got experts. You understand that? They have got experts, people who have been trading for years and years on their side, 30 years, 40 years, more than that, right? And they have got no limit in terms of time, okay? They have no limit in terms of time. Like for instance, you might have to go and sleep. You understand that? They don't need to sleep. Remember, we said there's the Asian session, right? Then we said there's the London session. Then we said there's the New York session, isn't it? You understand that? So it means that at every one of these sessions, when it's Asian session, when it's midnight by your side, midnight to 6 a.m., they've got fresh minds working. When it comes to 7 a.m. up to 1 p.m., there's another lot of fresh minds working. When it comes from 2 p.m. up to, again, midnight, the New York guys are there. Fresh minds are ready to go, okay? So you have got limited time because you've got your family, you need to do other certain things, whatever it is. So that is where you're limited. Another thing which institutional traders can do is they can dictate the market. They can't totally control it, but we're going to look at this, especially with the strategy which I teach, which is market maker method. These guys can actually move price. They might not be able to hold it, but they can move it for a certain period of time. Okay. Now, as a retail trader, you cannot move price. Because of what? Because of this, because of your capital. Your capital is limited, so you cannot move price. Okay. But these guys have got a lot of capital, which enables them to move price. Okay. Are we together? Hello? Yes, you can hear me? Okay, and another thing, institutional traders, they can hold a trade for months or even years. They can buy gold in January and sell it in December, waiting for it to get to the price which they want it to be at. You understand? Whereas with most retail traders, they can only hold a trade for a short time period, maybe daily, some even a few hours or weekly at the most. Because they want to get the profits in earlier, and they have to because price is always moving. Okay, so, and these guys are not so much at a disadvantage to brokers, whereas retail traders can be manipulated by brokers. That's why they want so many retail traders. That's why it's so easy for anyone to just open an account, because they know that you're going to lose your money. Why? Because you do not have that expert experience. You understand? They know that you do not have that expert experience, and they know that maybe you've got limited time and resources, so they take advantage of that. You see, so brokers take advantage of that. They allow you to open an account quickly, and they just want to take your money. Okay, because they work together with these institutional traders. That I can tell you. Although they might say they don't, but I can assure you there is a strong connection. Okay, so I think you've already downloaded MetaTrader 4. There's MetaTrader 5 as well. Have you? You have, because you've traded before. So just basically, yeah. So basically with the internet and a laptop or a smartphone, any retail trader can access the platform which the broker offers. There's also TradingView as well. But MetaTrader 4 for me is far much better, as well as MetaTrader 5. Okay, so this is what we're going to look at today. These are the foundational principles, I can say the key principles. This is what we're going to look at. We're going to define and understand. Okay, so when trading as a retail trader, you must know and capital. We're going to look at what is equity capital. We're going to look at this, because this can make or break you. Leverage, it can either make you or it can break you. But we're going to see how we can use this to our advantage, as well as the lot size. We'll see the spread. We're going to look at Pip value. We're going to look at what margin is. And one of the most important things, to avoid blowing account, margin calls, and stop outs, because this is what brokers enjoy. It's just stopping out you because your capital can no longer hold the position. Okay, we're going to look at all that. You're going to understand it, and then you'll have better understanding whenever you place a trade. All right. So let's just move to the next slide here. So equity, this is your capital, which you've deposited to open a trade position. Okay. So basically, in order for you to place a trade, you must have what? The necessary money for the broker to open that trade for you, isn't it? Which sounds pretty obvious, but as we go on, you'll see why it's more important. Okay, so equity is a trader's active balance in their account. That is money which you can withdraw. Okay, so if you put $20 in an account, that's your equity. If you want to withdraw it, if you've placed a trade, even if that trade, whilst that trade is running, you find brokers will not allow you to withdraw all of that $20. You understand? Maybe if it's up in big profit, they'll allow a certain amount, but once trades are running, they'll not allow you. Okay. So if a trader has active trades, the profit or loss of these trades will affect the equity. That's what I've just explained. So if you've got $20 in your account, you put $20 equity, but you've got a trade which is running, which is at, say, -10 or so, they will not allow you to withdraw this 20. They might not even allow you to withdraw 5 because you've got an active trade. Okay. So the size of the lot of a trade is affected by the equity which you have. Okay. So if you want to place a big trade, it all depends on how much equity you have. Okay. You cannot just enter lot size 10 with $10 or something like that. It's not possible. You understand? So equity, I think, is pretty straightforward. So this is very important. Understand this. When you are trading, only trade with money which you are willing to use. You understand that? This is a discipline principle, which, because trading is emotional, money is emotional. So whenever you trade, never deposit money which, if you lose it, you cry tears of blood. You understand? Of course, you may cry if you lose money, but never put more. Because remember, once you deposit that money into that account, it's not yours until you withdraw. Okay. So this is again on risk management. So now let's look at leverage, because this is what can make someone, or this is what can break them. Okay. So leverage is a strategy where you are allowed to use borrowed money. Okay. So you're actually borrowing money to place a position. Okay. So leverage, what it does, it allows you to control a much larger amount of money than you actually have. Okay. So the higher the leverage is, the greater the risk, and the greater is the reward as well. So let's just look at an example. Yeah. So you can just understand more. Okay. So different brokers offer different leverage sizes. Some brokers, they can offer you leverage of 1:5,000. I've seen that. Okay. So basically what happens now is that most of those, and I can already tell you, most of those brokers that offer you amazing leverages of 1 to 5,000 or something like that, they are usually the ones that are up to no good, because they use this as a trick to entice traders to say you can control what? A bigger sum of money. You can control a bigger sum of money if you increase your leverage. Okay, so here's an example of leverage. So if you deposit $100 using leverage of 100 to 1, you multiply that 100 times your leverage. Okay, and that enables you to control that amount of money, 10,000. Okay, 100 times 100 leverage. Now, institutional traders, most big banks and that, they trade with a leverage of even 1:1, meaning it's absolutely no leverage, or 1:2, maybe 1:3 is the most, meaning instead of controlling $100, they'll be controlling 300. And another interesting thing, the United States of America, the highest leverage I think they offer, I think it's 50 to 1. They do not allow their brokers to offer anything more than 50 to 1. It might be 100, but of what I know, it's 50 to 1. So they only allow a retail trader. So to them, they're sort of protecting people from manipulation. Okay. So you understand what leverage is? You'll be controlling more money. So that's what attracts a lot of people into trading, because of leverage. Because if you've got $10, you can actually trade as if you've got $1,000. Okay. So then we come down to the lot size. So what is a lot? A lot represents the standard number of units of a financial instrument set out by the exchange or regulatory body. The number of units is determined by the lot size. So it's the number of units. It's just basically a measure. So when trading currencies, metals, major indices, we've got the micro lot, the mini lot, and standard lots. Okay. So a micro lot is 1,000 units of a currency. Okay. A mini lot is 10,000 units of a currency. And a standard lot, this is what institutional traders normally trade, and even retail traders, you can trade. If you get to that level, you'll be trading this amount and more, which is 100,000 units. Okay, so shares, it ranges from 10 to 100 shares per lot, depending on whatever the broker is offering, but usually it demands more money. Then you have volatilities as offered by binary and derivatives, as I was saying. Now these guys, this is the only thing which I don't like about this binary and derivative, is that they have got different lot sizes. They have a minimum size lot requirement, and they keep on changing this. You know, they keep on changing the lot size. So that's why, yes, you can trade it, but the fact that they are continually changing lot sizes required, you know, you can be placing a trade, next thing you find out they update you with adjusted the minimum lot size requirement. You know, for me, it's a sign of smoke. But of course, you can still make money there, you can still trade there, but it's a sign of smoke, because even regulation Like I think in Europe, they're not allowed to trade. So all those sort of things, those are red flags. But anyway, you can trade it, but just have that in the back of your mind. So that's your lot size, right? So here's an example. So basically, the larger the size of the lot, the higher the required equity, and the higher the probable profit or loss, and vice versa. So there's our standard lot. We said 100,000 units, right? So that is lot size 1. Mini lot, 10,000 units, meaning like $10,000 of that currency, which is 0.10. Then we've got the micro lot, which is 1,000 units, meaning like, say, $1,000, right? Which is 0.01. Then the nano lot, this you can trade on a cent account, which is 0.01. And you can see the value. We're going to look at Pip value. So basically, when you place a trade of one standard lot, when price moves 1 pip, $10 has moved up or down. When you place a trade, a mini lot, 0.1, when price moves up or down 1 pip, $1 is gained or lost. And then the micro lot, which most beginners, retail traders, they use the 0.01, you gain roughly 10 cents per pip. Okay, we're going to look at this. So now the spread. The spread. So the spread, this is basically where the brokers, they basically guarantee themselves money. So even if you're a really good trader and you keep on winning on all your trades, sorry, let me just go back. You keep on winning on all your trades, where they make the money is on the spread. So the spread is the difference between the buy and the sell prices quoted for the asset. Okay, so the spread is a key part. CFD trading is how both are priced. Many brokers and market makers, now the providers, will quote their prices in the form of a spread. It's basically your broker's charge for opening a trade for you. Some brokers offer low spreads but high commissions. Others offer reasonable spreads but no commissions. Brokers can, this is very important, something which most guys don't realize the significance of this point. Brokers can change the spread anytime, even during a running trade. In fact, always during a running trade. It's there in the where you click, yes, I agree to these conditions. It's there in the fine print. They can change the spread anytime. What does that mean? It means that if you are in a trade, they can just, we'll get more into this, but basically they can increase your loss. If you're on a loss of $10 and they widen the spread by, say, 10 pips, you can land up being in a loss of $15 and it can blow your account. So we're going to look at that. We'll look at how we can use this to advantage. So the spread you cannot control. So some brokers, the spreads are even zero or very low, but they charge you commission whenever you want to withdraw. So yeah, 2 charts. Can you see the charts? Okay. So these I just extracted they're recent. So if you see the red line and this gray line, this chart, I think this was pound. Yes, this was the pound US dollar on the 17th of August. So basically, if you wanted to buy, remember we always say we want to buy low and sell high. So in this case, if you wanted to buy, they were going to enter you at the red line, not at the gray line. So they enter you at a higher level. And if you wanted to sell, when you press sell, they're not going to enter you at the higher level, they're going to enter you at the lower level. Okay, so price is basically in the middle, but they're just going to, it's their charge. So you can see this is a fairly small spread, right? You can see the candles there. The spread, I think you can even see there, it's 1 pip. Can you see that? On my indicator here, it says spread 1. So the spread is 1 pip. Now on the right here, you see the significance of spread. This is a chart of Bitcoin, okay? Bitcoin versus the US dollar. So can you see the difference in the spread? Just have a look at that. That's, if you were to buy, instead of buying at, say, maybe price is at 11,830, instead of buying there, the spread, you're going to jump in right up here, 11,848. So already, that's about how much? That's about already like $20-something just for buying. You understand? Because they're going to enter you at this higher price, whereas price is probably just there in the middle. So this is quite a significant gap. I mean, 11,845, 11,818. That's like $30. You understand? So depending on your lot size, it's a different value, but the spread is very wide. As you can see how wide it is. But that is because they say it's a more volatile asset, meaning that it can give you big gains. It moves fast. It moves a lot. That is Bitcoin, cryptocurrency. You can trade it as well. Okay, so the value so far, let's just remind ourselves what we've done so far. We've dealt with equity, leverage, right? The lot size, right? Lot size, we've dealt with spread. So we've done 4 things. Now number 5, the Pip value. Remember, even when we were here on lot size, we said there's a Pip value based on the lot size. So pips, what is a pip? A pip in finance, specifically foreign currency exchange, is called, it's short for percentage in point or price interest point. So it's the percentage that price changes. So that's why we count using pips, and those pips have got different values. So it's the percentage in point change, okay, of that currency or asset, right? In FX, usually the pip is the 4th decimal place in the pip. So if we have $1, let's say 24.11, right? So this is our pip, this one, yeah, the 4th one. If we're saying this is $1.24.11, so this is our pip. If it changes to 12, we say it's gained 1 pip. Okay, so we count our profit or loss by the number of pips gained or lost. Okay, here's an example. If GBP USD GU is at $1.30, that means that it's $1.30.10 to buy £1, and moves up to $1.30.12. We say it has gained 2 pips. Okay, so it's from here. You understand this? Are we together, Sam? Okay, so just something I'll add here. Whenever you see a pair or anything quoted like this, GBP USD, this is the base currency or the base asset. This is the base, the one on the left. So that's the one which that is the base, okay? The one on the left. And then this is the quote, right? This is the quote currency. Okay, so if we say GU is at 130.10, it means that you must pay $1 30 cents and 10 whatever mini cents to get £1. Okay, so that's how you make money, is that when it's low and it goes up, that will mean pound has gone up, meaning it will now cost you more US dollars to get £1. So basically, the higher, if you're buying, the higher this goes up, the more money you make. If you're selling pound, US dollar, the more this goes down, the more you gain. Okay, so basically the pip is this 4th unit. Okay, that 4th unit, that's how we count the pip. So it gained 2 pips. If it moves down to 130.05, what's the difference there? 130.10 to 130.05. The difference between these two has gone down. It has gone down by 5 pips. Okay. Yes. So like as we saw with the lot size, each pip has a different value depending on the lot size. You remember the chart which I showed you just now? Let's see if we can go there. You remember it, right? So the higher the lot size, the higher the pip value. So the pip value is defined by the currency pair being traded, the size of the lot, and the exchange rate of the pair. The pip value is the monetary value. So if you tell me you made 50 pips today, if you're trading a nano lot, that can be 50 cents. You understand? If you're trading a micro lot 0.01, that can be $5. If you're trading a mini lot, that should be 0.1, that can be $50. If you're trading a standard lot, that can be $500. Okay. So good brokers, this is a good way of seeing a good broker. They give you a table where you can find out the value of the pip and the different lot sizes. Okay, we'll look at that. It's a very handy tool. But now this is the main. If you want to get something from everything that we're doing today, get this today. Get what margin is, because I tell you, your broker will never tell you about their margin. They will tell you about bonuses. They'll tell you about bonuses and all that, but bonuses, they do not affect your margin. They offer bonuses. They offer high leverage. They offer low spreads. All that is just like a mirage. But the only thing that matters at the end of the day is margin. Okay, so what is margin? Margin basically is the amount of money that a trader needs to deposit. Remember when we started with equity? In order for you to place a trade, you need to have so much money in your account. Okay, so margin is the amount of money that a trader needs to deposit in order to place a trade and to maintain the position. Okay, so what is margin? Margin is free equity required to open the trade. So it's the amount of free capital which is not being used. If you've got one trade running and you want to place another trade, you cannot place that other trade unless you've got a certain amount of free equity. Okay, so this is how you get margin. Margin is your lot size value divided by the leverage. Okay, let's look at an example. So remember we said margin is what? Is the amount of money required. This is margin. And the amount of money that you require to keep that deposit open, to keep that trade open. Okay, so micro lot of 0.01 euro US dollars at a leverage of 100, the margin required, remember we divide it by leverage. So if you're using a 1-to-1 leverage, you would require $1,000 to open this size of 0.01. That is if you're using a leverage of 1-to-1. But because you're using a leverage of 100-to-1, you divide 1,000 by 100. So all you need to open that trade is $10. This is where leverage comes in handy. You understand? So you need $10 free capital to open that trade. Okay, so that is what margin is, how much money you need to open a position. So if you try and open 0.10 and you only have $10, the broker will not open that position. Okay, so point number 7, this is where the broker, the dealers, where they get everybody: margin calls and stop outs. Okay, so as we've seen, margin is unused equity required to open and maintain a position. I gave the example of a micro lot of 0.01 US dollars, which is basically you're using 1,000, you're buying 1,000 units of the currency, but at leverage of 100, you divide the 1,000 by 100, and you only need to put $10 up front. That sounds good, right? It sounds good that if you can control 1,000 by only putting 10, right? But this is very interesting. If you have $10 in your account and no other trades opened, your margin level, okay, your margin level is what? Is 100%. Yes, that is your margin level. So this is where they get you. In the trading platform, you'll always see it shows your margin level at the bottom, or even on your cell phone, you can see it. So if you have $10 in your account and there's no other trades open, your margin level is 100%. If the trade goes against you, your margin level, what? It goes down. The moment the trade goes against you. If it goes for you, your margin level goes up, and they could allow you to open another position. Okay. So in this example, the pip value is about 10 cents. The 0.01. So if your trade is now at minus 20 pips, you are at minus $2. Meaning your equity is now how much? You're right. Meaning your margin level is now how much? 80%. Now, if you didn't know, brokers can close your trade once your margin level is below 100%. They're allowed to do that. So it means that if you have 10 bucks and you place this trade, it means even if they're allowed to close it once it goes below 100%. Because remember, they said to you, basically what the broker said to you, okay, Mr. Trader, you want to trade 1,000 units of this currency, but you only, at leverage of 100, you only have $10. We will allow you to place $10 up front in order to control 1,000. But if you do not have $10, what happens? You can't open that position. So that's why they can actually give you a margin call or stop out if you go below 100% margin level. Okay. So this is the most important thing whenever you place a trade, is your margin level. So other brokers, what do? They simply stop you out. A stop out is where you can just come and you find your account is on 0 and you'll be like, what happened? How did this? Or they close your position. And you wonder, but I still have money in my account. Why is this position closed? Because in the small print, they're allowed to do that. They can stop you out, close your position, and at times your entire capital will be taken. So some are courteous. They give you a margin call. They send you an email or text message to say, sir, your money, you put $10 up front, but now you're below $10. Can you top up? Isn't it? And if you don't, they're allowed to close. But most guys, actually, they allow you to go up to like 70%. 70% margin level. Although others are more lenient, they allow you to go up to like maybe 40%. But basically, when you're getting there, you're now really over risking 40%. 40% margin level. Yeah, you're too far gone, and they can just shut all your positions. That is what they do. Okay. Sorry, let's just go back there. Putting this all together. Let me just clear all of this. So CFD trading, like we said, it's all about probabilities. We're all about anticipating, hoping that price, if it's down here, we're hoping price is going to go up. If we're going to buy, this is for a buy. And for a sell, we're hoping if it's up there, we're hoping it's going to go down. We sell high and we buy low. All right. So as a trader, there's things you cannot control. As a retail trader, you can't control price movement. You cannot control the spread. Remember, the broker can open or close the spread anytime. And you cannot control the pip value. That's basically, you'll see it's more or less the same, but some assets, the pip value is a lot higher than others. But as a trader, this is what you can control. Your lot size before you enter. Your leverage, right? When you control these two, you are indirectly controlling your margin. Okay, you're indirectly controlling your margin and your margin level. As well as, of course, you can control the equity, the amount of money which you're willing to put up front, which is tied to margin. So a lot of guys, they just focus on the size of the lot how much leverage can I play with, but not realizing it's all about how much money you put up front and how much margin you can hold. You understand? Because for an example, let's say let's just use that example. All right, I'll show you this just now. I wanted to show you to you now. I'll show you to you just now. We'll go to the calculator. So always calculate before entering a trade. Focus on the required capital, that is the margin, at a specific lot size, and see how long you can hold that trade for. By what? By looking at the pip. You understand me? By looking at how many pips. Because if your capital is say $10, right? And for you to control that 0.01, we said this is 10. So you need to find out the pip value. Because the moment, remember I said the moment this thing, I gave you the example when it's on minus 20 pips, right? If it's on minus 20 pips, already you are on what? It's another minus $2, right? Basically, 20 pips equals to minus $2. So the brokers don't tell you that. They just tell you how much you need to put up front. All that nonsense of bonuses, all it is increasing risk, because a bonus, all it does not increase your margin. It doesn't. You can even ask the brokers. Some of them have cross-quizzed them to say, this bonus, what does it benefit me? It doesn't benefit you anything. All it does is, instead of you opening the maximum lot size of, say, a lot size 1, which maybe if it goes against you 1 pip, your account is blown. What they'll do with that bonus, they'll say, oh, we're giving you 100% deposit bonus. We're giving you an extra $10. No, they're not giving you anything. All they're doing is they're saying, increase your lot size. So instead of entering lot size 1, you enter size lot size 2. And if it moves half a pip against you with your $10, you're gone. You see? So the bonuses, they don't actually mean anything. So the most important thing is realizing this. How many pips going against you can you handle? That's your stop loss. There's no use you putting a stop loss 50 pips away. We'll get into all this to say that, oh, if it goes against me by that many pips, then I'm going to close. You understand? Whereas in actual fact, if it goes against you, say 25, your account will be closed. You understand? So thankfully, most brokers, they offer you a trader's calculator. I don't know if you used this before. A trader's calculator. All right, let's open it. I've got it here. I'll open it. You can see the shortcut. Should have it here. Let's just open it. So that you can see. So it makes it simple, because maybe you'll be like, how do I calculate this? How do I calculate that? But most brokers, let's have a look at this trader's calculator. Okay, this is one of the brokers that I use. This is XM, right? So as you can see here, if you're trading, most of us, we trade our base currency as US dollars. If you want to use any other, but basically it's just all the same. But most we use US dollars, meaning your account is a US dollar account. So you select the pair that you want to trade. So let's say, for example, we use the example which I used, the GU, pound US dollar, leverage. Say you want to use 100 to 1. The account type is a standard account. Standard account. So there you have your lot sizes. So let's say the micro lot, you want to trade 0.01, you just go to calculate. Now remember what I spoke about the margin? You recall? We spoke about margin. When we spoke about margin, yes, as you can see, what does it say here? Required margin, right? You see what it says there? $13.36. So to trade a micro lot size 0.01 of pound US dollar of leverage of 100 to 1, they will want you to have $13.36 in your account. Okay, you understand that? You get that, sir? Yeah. So meaning that this is your 100% margin level. And there we get what? The Pip value. Can you see the Pip value there? It's saying what? 10 cents, right? 10 cents. So meaning that if the trade goes against you by 1 pip, you're down 10 cents. If it's 10 pips, you're down $1. If it goes for you 10 pips, you're up $10. I mean, you're up, $1, 10 pips. Okay. So remember, each time it goes down, what's happening? This margin level is what? Is going down. And remember, I told you the moment it goes below the risk required margin, they are allowed to close your account. But although they'll allow it to get to maybe 70, 60%, some allow it to get to 40% before they close. Okay. So this is what you need to always look at before you enter a trade. You understand me? So if you're going to enter pound US dollar, you must look here to say, all right, if I'm required 1336, 10 cents a pip, how many pips is that? To me, that looks like 133 pips will get this to 0. So you want to look to say at least 40% of this required margin, because like that's your stop. You understand me? Because the moment you're even 30, okay, what's 30% of this of 1336? Have a calculator. Let's see if I can get a calculator. Because remember I said once your margin basically is below 80, 70. So 70%, let's just say that 1336. No, 13.36, that's $13.36, right? If we say times, I want to know what is 30% of this, times 0.3, right? That's $4. Okay, $4, and we say the pip is how much? 10 cents. So $4 divided by 0.10 should give me how many pips? So that's how many pips I can hold for before these guys will shut down the trade. 40 pips. You understand? So don't worry, it won't be difficult. You've got the trader's calculator. You just get this when you see required margin. You look at, you say, okay, what is 30% of that? I have $13.36 in my account now. So I know that if I lose 30% of this, my margin goes, that's without entering any other trade. If I go below 30%, it's as good as they can close my account. So that's what we need to really look at, not at anything else. Okay, and they will not tell you this. So basically here, they will not tell you this. So you can change this, because someone just comes, oh, I'm entering at 0.1. Let's calculate. Leverage of 1 to 100. You see how much money they want? $133. But that's leverage at 1 to 100. But what do guys do? They love to use the highest leverage. Let's put the 888. You see how it will change. So that's again using this micro lot 0.10. Now notice, you see how much he wants. How much is that? 15 bucks. But how much is the pip value? $1. You see that? The pip value is $1, meaning that what is 40% of $15? Let's just have a look at that again. Where's my calculator? Or are we at the end now? But I want this, so $15, right? Sorry. Let's just go there. What's happening? $15. I want 40% of that. $6. And the pip value is how much? We divide by the pip value. Pip is 1. So how many pips? 6 pips. And your account is blown. You see? So someone just goes to throw a high leverage and they go to throw a high volume in lots. And to tell you the honest truth, for you to enter a trade with 6 pips, remember I haven't even yet put in the spread. Remember there's the spread where the broker charges you a spread. Some pairs the spread is even more than $6. And overnight trades, they open the spread. Remember when I spoke? So just look at this shortcut here. You just see it there. I know FPS, they have one as well. You just go to Traders Calculator. They have it there. So like as I'm saying, you just come here. You can even calculate your profit and loss, but and all that. So you just choose the pair you want, whichever pair it is. Choose the leverage. So you see, it doesn't really matter the leverage. What matters is, can you hold that trade open? Okay. So all this, it will give you that. It's important. So that's how we put all of this together. You control your lot size, you control your leverage, remember, but the most important thing is your margin and your margin level. Okay. So for us, before we move on to the next lesson, not today, but when you're ready, before we move on to the next lesson, you should be able to do all of this for me. If you can take a picture of this screen or write this down. This is what I'd love you to look at and do. You've taken a picture. So basically, I want you to just like before we meet the next time, I want you to give me this, your own definition of what CFD trading is as you understand it. Okay. Then I want you to list differences between institutional traders, retail traders. List, you've taken the picture, right? Things you can control, 3 things you can't control. Then I want you to open your MTR4 and find out the pip spread size of 3 different pairs and get the value of those spreads. Remember, I showed you how to get the pip value. So you just, when you open your MetaTrader, you see the difference in price, how many pips it is, what the spread is. You know, basically on your MTR4 on the phone, when you just look at the price, it shows you that. Or even, let me just open an MTR4 here. Just open a chart. Okay, even if I just say new order, can you see this quote? So already you can see this is 1, 2, 3, 4. 1, 2, 3, 4. So the spread here basically is this 18 minus this. See, it's changed. It's 18 minus this 15, right? So it's basically 3 pips, the spread, which is these 2 lines here. Okay. So just get the spreads of 3 different pairs, find out the value. Okay. Then I want you to complete this table using the online calculator. Okay. Go to GU select that lot size, select that leverage. Then I want you to find out how much you saw it shows you. It shows you this, the margin they want. It shows you this, the pip value. Then I want you to say how many pips equals the required margin, right? Then you remember that 40% of this required margin is basically your stop loss.